Welcome to the Deep Dive. We cut through the earnings call noise to bring you what really matters.
That's the plan.
Today we're tackling Synopsys, ticker SNPS. Their Q3 FY2025 call just happened September 9th.
And it was interesting. Big strategic moves, definitely.
Yeah, but also some unexpected problems that hit the stock pretty hard.
Exactly. So our job today is to unpack all of that for you, make sense of the numbers and the strategy.
Let's start with that market reaction. It was fast and, frankly, negative.
It really was. Synopsys missed on some key metrics, and, that kind of set the tone immediately.
Okay, let's get those headline numbers out. Non-GAAP EPS, so that's adjusted earnings per share, came in at $3.39. The street was looking for something more like $3.74 to $3.80, so a miss there.
A noticeable miss. And then revenue, the top line, $1.74 billion.
Which sounds good. I mean, 14% growth year over year is solid.
It is solid growth, but analysts were expecting closer to $1.77 billion. So short there, too.
And the standard GAAP EPS was $1.50.
Right.
So missing on both adjusted earnings and revenue. You can see why the market got spooked.
Absolutely. Add in a more cautious outlook, and, well, the stock took a dive in after-hours trading. Big concerns from investors, clearly.
It really highlighted that gap between, management's big picture story and the market wanting solid near-term results.
Precisely.
Okay, let's dig into those financials a bit more, because it wasn't all bad news.
No, definitely not. Their design automation segment, actually quite strong.
Especially the hardware side, right? For AI workloads.
Exactly. That part was up 23% year over year. Hit $1.31 billion. That's a serious tailwind.
It really shows how plugged in they are to that whole AI build-out.
It does. But, and this is the big but this quarter.
The design IP segment?
Yeah, their intellectual property business. Yeah. That really struggled. It saw an 8% decline compared to last year. Pulled in only $428 million.
Wow, okay. So one core business booming, the other shrinking year over year. That's quite a split.
It really is.
And this was also the quarter we saw the first numbers from the Ansys acquisition finally land.
That's right. The huge $35 billion deal closed mid-quarter, July 17th.
So not a full quarter impact yet.
No, just a partial contribution. Ansys brought in $78 million in revenue. Most of that is now in what they call the simulation and analysis, or S&A, product group.
Okay. And a smaller bit in their traditional EDA business.
A smaller slice, yeah. This Ansys deal is clearly their major bet for the future. Diversification, bigger market.
Right. And despite the IP issues and the miss, the underlying demand seems, still there. They mentioned backlog.
They did. A pretty robust backlog, actually,
yeah.
$10.1 billion. And that includes Ansys now, so that provides some, visibility.
Okay. And cash.
Ended the quarter with $2.6 billion in cash and short-term investments, which sounds good, but the debt level jumped significantly because of Ansys. It's now $14.3 billion.
Oof. Yeah, financing a $35 billion acquisition will do that. What about cash flow?
Free cash flow was about $632 million for the quarter. Oh. So still generating cash, but that debt load is something to watch.
Definitely. Okay, so that's the picture from the numbers, a real mixed bag. How did management explain all this? What was their narrative?
Their narrative was heavily focused on transformation. They kept calling Q3 a transformational milestone.
Because of Ansys, mainly.
Primarily, yes. They see it positioning Synopsys as this leader in engineering solutions from silicon to systems, basically covering the whole design process, way beyond just the chip itself. It massively expands their potential market, in theory.
A big vision. But they couldn't ignore the IP miss. What was the story there? I saw they mentioned 3 specific things.
They did. And it paints a pretty tricky picture for the IP business right now. First, those new export restrictions affecting China.
Right, we heard about those.
It said disrupted design starts, but the impact on customer behavior, the uncertainty it created, lasted way longer than the actual restriction period. People got hesitant about multi-year deals.
Okay, that makes sense. What was the second factor?
Challenges at a major foundry customer. So one of the big chip manufacturers. Synopsys had apparently made some pretty big IP investments targeted at this specific customer, but they didn't get the returns they expected.
Why not?
Management said it was a mix of sort of market issues and customer-specific problems that were, quote, beyond Synopsys's control. A bit vague, but clearly a significant hit.
Okay. And the third reason? This one seemed more internal.
It did. They admitted some internal roadmap and resource allocation choices in IP didn't pan out.
Like what?
They gave an example of investing heavily in edge AI opportunities, but maybe that meant neglecting other potentially bigger opportunities in foundry or data center IP, making bets that didn't quite pay off this time.
So a combination of external shocks and some internal missteps hitting the IP business all at once.
Seems that way.
Yeah.
And don't forget, alongside Ansys, they're also selling off parts of the business. Power Artist and the Optical Solutions Group are going to Keysight.
Right. That was needed for the Ansys regulatory approvals, but also helps them focus, they say.
Exactly. Portfolio cleanup.
So given all these IP problems, what are they actually doing about it? How are they trying to fix it?
They're actively shifting resources, redirecting IP efforts towards what they see as the biggest growth areas now.
And changing how they're organized.
Yeah, that was interesting. They're merging some standalone IP engineering teams directly into their system solution groups.
Why? What's the goal there?
The idea is to speed up development of more complex stuff. Think subsystems, not just individual IP blocks, and especially chiplet-based solutions.
Chiplets, like Legos for chips. That's a big trend.
It's a huge trend.
Yeah.
More customization, more integration needed. So they're trying to align their IP teams better to deliver those more complex integrated solutions. It's a fundamental shift, really.
Makes sense. But even with IP struggling, they kept hammering the AI theme, right?
Oh, absolutely. That remains the core growth driver narrative. Demand for high-performance computing for AI chips is still fueling investment in their main design automation tools.
They mentioned customer pilots for their AI tools.
Yeah, Synopsys.ai said about 20 customers are piloting it.
Yeah.
And of course, Ansys brings simulation and analysis into that AI story more deeply.
Okay. And beyond fixing IP and pushing AI, any other big moves? Cost cutting.
Yes, two things there. One, a big strategic review of their whole portfolio is underway. Two, they're launching this internal project to use custom generative AI, Gen AI, to boost their own productivity.
Interesting. Using their own medicine, so to speak.
Kind of.
Yeah.
And tied to all this efficiency focus, there's a significant headcount reduction planned.
How big?
A 10% cut in global headcount planned to be completed by the end of fiscal year 2026.
Wow. That's substantial. Was that a reaction to the bad quarter?
Management explicitly said no.
Yeah.
They see that this reduction was planned anyway, regardless of the Q3 IP performance, part of the longer-term strategy and Ansys integration, presumably.
Okay, let's pivot to the outlook. What are they telling investors to expect next? Guidance for Q4.
For Q4, non-GAAP EPS is guided between $2.76 and $2.80. Revenue expected between $2.23 and $2.26 billion.
And for the full fiscal year 2025, that includes Ansys now.
Right. Full-year revenue guidance is $7.03 to $7.06 billion. And non-GAAP EPS for the year targeted at $12.76 to $12.80.
Did they sound confident or?
They used the phrase more cautious view for Q4.
Why cautious?
Well, they pointed out a couple of things. There's a fiscal calendar change, which means FY25 actually has 8 fewer days than usual. That has an impact.
Okay.
And they're assuming, maybe prudently, no further changes to export controls. Also, they lowered the free cash flow target for FY25.
Why lower cash flow?
Partly the lower revenue outlook, but also the higher interest payments kicking in from financing that huge Ansys deal. Debt costs money.
Right. And what about the IP business specifically? What's the outlook there?
They're preparing investors for a transitional and muted year for IP. Basically saying the turnaround will take time, the headwinds won't vanish overnight. They expect them to stick around beyond Q3.
So near-term pain in IP is expected, but longer term?
Longer term, they stuck to their guns. Reaffirmed their commitment to getting operating margins into the mid-40s% range eventually. They still believe the strategy, including Ansys, gets them there.
Okay, so let's tie this all together. What does it mean for you, the listener, trying to figure out Synopsys now? That stock drop 18% after hours was brutal.
It really was. And it showed the market just wasn't buying the transformational story right now. Investors zoomed in on the IP miss, the China issues, the softer guidance.
Especially when competitors like Cadence had recently sounded more upbeat, right? Raised their outlooks.
Exactly. That contrast probably made the Synopsys news feel even worse.
This call also really felt like it laid bare how much the IP business itself is changing.
Absolutely. It's moving away from just licensing simple blocks. It's about these complex subsystems, chiplets.
Yeah.
Much more customization needed.
Which changes the business model.
Potentially, yeah. Synopsys mentioned exploring models with a royalty component on top of the usual engineering fees, NRE, and usage fees. That's a big shift.
And likely means a transition period, maybe hitting margins or requiring different execution skills?
Could be. It's essential for the future, but transitions aren't always smooth. Execution risk is definitely there.
And that geopolitical risk isn't going away either. The China export controls, it's not just a blip.
No, Management made it clear it's affecting long-term customer decisions, multi-year commitments. That adds a layer of ongoing uncertainty, even if the core AI demand drivers are strong.
So the Ansys deal becomes even more important as a diversification play.
Right. It diversifies the products, the customer base, even the geography. Ansys has a stronger footprint in Europe, for example.
Less reliance on any one area.
That's the hope. But investors will need to see proof. Integration milestones, actual synergy realization, those will be key things to watch in the coming quarters. It's definitely a long game management is asking investors to believe in.
Okay, this has been a dense quarter. Let's shift gears slightly to our divergent investor perspective segment. Remember, this is absolutely not financial advice. Just exploring plausible, maybe even bold ways investors might react.
Definitely not advice, just food for thought.
Okay, perspective one, the AI infrastructure bull case. What's the thinking here?
The argument goes like this. Synopsys is indispensable for AI chips, period. Yes, the IP business stumbled, but that's temporary noise geopolitical stuff, one tricky customer. Fixable problems.
And Ansys.
Ansys makes them the king of silicon to systems, perfectly positioned for AI, digital twins, the whole mega trend, so that 18% stock drop.
An overreaction, according to this view.
Exactly, a gift, a buying opportunity for the long haul. This investor believes management will fix the IP issues, integrate Ansys smoothly, and ride the massive AI wave. The current dip is just turbulence on a multi-year climb.
So maybe looking at long-dated call options, betting on that recovery and growth?
That could be one way to play that bullish view, yeah, betting on the long game.
Okay, now for the flip side, perspective two. The geopolitical headwind and execution risk bear case.
This view is much more skeptical. It says, hold on, those IP problems might not be temporary. They could reflect deeper shifts, maybe persistent China issues, meaning that muted FY26 outlook isn't a transition, it's the new normal for IP.
And Ansys doesn't automatically save the day?
Not necessarily. Ansys adds huge complexity, tons of debt. Those synergies, maybe they take way longer or aren't as big as hoped. And what if that shift to complex subsystems permanently changes the IP margin profile for the worse?
So more execution risk, more debt risk, persistent headwinds.
Right. So this investor might think Synopsys is heading into a tough operational slog. Maybe they short SMPS directly.
Or pair trade.
Or a pair trade, yeah. Short SMPS, go long a competitor like Cadence that seems to be navigating things more smoothly right now. Basically betting that Synopsys struggles while its rival gains ground.
Two very different takes on the same set of facts.
That's usually how it works in the market.
Okay, let's wrap this up. To recap, Synopsys' Q3 was this real mix. Huge strategic step with Ansys.
Definitely transformational in intent.
But overshadowed by misses, driven by that challenged IP business and those ongoing geopolitical factors.
Management's talking pivot, talking cost cuts, but the market focused squarely on the immediate problems.
And remember, everyone, what you've heard today is our analysis of the earnings call. It is absolutely not financial advice.
Please do your own research. We're just breaking down the information and exploring the different angles.
So as we think about Synopsys trying to become this silicon to systems powerhouse while navigating these choppy waters, it leaves us with a final thought for you. In today's complex tech world, how much uncertainty are you willing to stomach for a company pursuing a potentially huge long-term transformation, especially when the near-term path looks, well, pretty bumpy?
It's a key question for any investor looking at a story like this.
We encourage you to dig deeper and form your own view. Thanks for joining us on The Deep Dive.